Okay, chapter 17, the final chapter for investments for the semester, futures markets and risk management. So a futures contract, a forward contract is an arrangement calling for future delivery of an asset at an agreed upon price. So I could say things like, I want to buy it for $1.50, I buy wheat for $1.50 a bushel, 6 months from now, or a year from now, or 2 years from now, whatever that is. So the price I'm quoting is the agreed upon price paid in the futures contract at maturity. A long position is a trader who commits to purchasing the asset, and the short position is the one who commits to delivering the asset. So futures, long futures profit, F0 is where the price break is effectively, so how much I'm making based on whether or not the price actually reaches what my agreed upon price is or not. Short futures, you can see the profit is the opposite. If it doesn't reach the price, or if it does reach the price, then I'm losing money by selling it for that price. Versus we got what it looks like to buy a call option over here. So existing contracts, single stock futures. A futures contract on shares of an individual company, where I agree to buy, again, a certain actively traded stocks or indexes. And not indexes, excuse me, this would be for individual stocks for a company. We have index ones later. So this would be examples of different types of futures contracts. And some of the areas I've worked in before, I've worked in the agricultural industry where I had futures contracts on all these types of things: corn, oats, soybean meal, soybean oil, as well as crude oil, gas oil, natural gas, those types of things that I've seen futures contracts and worked with futures contracts on at one point in my career. The clearinghouse, the trading mechanics and how this works. The clearinghouse and open interest. The clearinghouse facilitates the trading. They're the intermediary, between the two traders, closing out the positions, reversing trade or take or make delivery. And then most trades are reversed and do not actually involve an actual delivery. So it's really common for the trade to actually be reversed. And then open interest is an open contract, not offset with the reversing trade. All right, trading with and without a clearinghouse. So this is how the different positions would be if I don't use the trading house at all. It's just directly between the one who's offering the contract and the one who is promising the delivery of the commodity. Whereas if we have a clearinghouse, the money can never actually necessarily reach the short position or long position. So the clearinghouse, effectively, you can just deal with directly. I mean, the good thing about that is that's when you're seeing that the likelihood of there not actually being a delivery made. More of a buying and selling of contracts and options and future prices. Marking to market and margin account. Marking to market is daily settlement of obligations on future positions. So settling up on new future positions as you have. The maintenance origin is the value between which traders' margin may not fall. This triggers a margin call. So if the margin falls below something, then they can call that margin at the time that it actually falls below. Convergence property, convergence of future prices and spot prices at a maturity of the futures contract. So when my futures prices and my spot price are equal at the end of that futures contract, whatever the time frame or the length of that maturity is, when those prices are equal, that's convergence property. Cash versus actual delivery. Cash settlement, cash value of the underlying asset delivered to satisfy the contract. So what they're talking about here is if you think about if there's a futures contract, and let's say you don't have the commodity, either you've sold out of it or something happens where you're not willing to sell it for that price, you can settle that with cash. And the cash settlement would just be the difference between the price that's on the futures prices, and the actual price at the time the delivery was intended to be made. Regulations. It's regulated by the Commodities Future Trading Committee. Exchanges can set limits on one-day price changes, where it can't change too much, even if price changes get to be they're protecting against major volatility basically in the commodities area here. Taxation is paid at year end on cumulative profit or losses, regardless of whether the position is closed or not. So this is different than usual stock. Usually you're only paying tax on stock transactions unless you got dividends, but actual stock transactions usually only if there's a gain, if there's a buy or a sell. Whereas this, it's cumulative profit or losses, whether or not the position is closed, whether or not the actual delivery has happened, whether or not the money has actually changed hands. Trading strategies. There's speculation, there's hedging. Speculation, if you're short, you believe the prices will fall. If you're long, you believe the prices will rise. And hedging long, your endowment fund will purchase stock in 3 months. Manager buys futures now to protect against a rise in price. And short, the hedge fund invests in long-term bonds. Manager worries interest rate may increase and sells futures. So this is revenues are constant at $89.48 per barrel. This is the proceeds per barrel for the, and I believe this is using crude oil. And as the sales revenue increases when the oil price increases, profit on the short futures falls with the oil price. 89.48 you can see is where these lines cross, and that would be the futures price in this case would be 89.48. So think about this like I agreed to buy a certain number of barrels at $89.48 at a given point in the future, and so when the price goes between, or when the price goes either over or under the 89.48 is when my position changes depending on the short or the long. All right, basis and hedging. The basis is the difference between the futures price and the spot price being the current price basically. The basis risk is the risk attributable to uncertain movements and the spread between the futures and the spot price. And the spread for futures is taking a long position in a futures contract of one maturity and a short position in another in the same commodity. And this is betting on the spread between the two, betting on the spread between the short and the long position. The spot futures parity theorem. Purchase a commodity now to store it, simultaneously take a short position in the future. All-in cost of purchasing the commodity and storing it, including the cost of funds, must equal the futures price to prevent arbitrage. Okay, no arbitrage condition. We can borrow, we can buy for the spot price, or we can sell futures for the short. And remember, this is another one where we could end up, if we hedge correctly, under no arbitrage conditions, we can end up with a zero initial cash flow. So the strategy would be cost zero initially, cash flow at T must equal zero, therefore future zero, spot price zero, plus one. The futures price equals the spot price minus the cost of carrying that inventory or that commodity. Strategies have the same cash flows at the same time, so the T would be the time in this case. The futures price again equals the spot price minus the cost of carrying it. So strategy A would be just to buy gold and the flows at time T. And the strategy we've got long futures, investment in bills, and then the totals for buying. Okay, this is a dividend yield annualized for January 06 through January 2017. Sorry, hold on one second. All right, so as you can see, the vast majority of this dividend yield annualized is between 0 and 3% pretty much always, with the exception of a couple of spikes, one spike here in January of 09 or so, where it reaches up above 4%, but pretty much pretty steady at between, a little over 1% and just short of 3%. So really just a 1.5% difference overall in an 11-year period. This is a futures gold price. So gold prices for contracts maturing in August 2017, December 2017, and April 2017. So when the delivery actually happens, you can see the difference in pricing. You see that it trends up for the futures price. And that would happen if they believe that the prices are going to be steadily rising on gold throughout this given time frame. Stock index futures available on domestic and international stocks. There's several advantages over direct stock purchases. One, it's usually lower transaction costs because you're buying groups, a lot of kind of like a mutual fund type situation. Usually it's easier to implement timing allocation strategies when you have diversified purchases you're already making, because when you buy a stock index, that's already inherently diversified by buying into an index. In the first place, is the reason indexes are what they are is that they're supposed to be representative, which means they're diversified across the market. All right, so index futures, different indexes and index futures, what the contract size are, and where the exchange actually happens for the different indexes. Correlations among major U.S. stock market indexes and monthly returns. This is 2012 through 2016. about half 2016. And you can just see that, you know, the S&P 500 returned lower than the Dow Jones and NASDAQ, and so on. So creating synthetic stock positions. Synthetic stock purchase is the purchase of stock index futures instead of actual shares. It allows frequent trading at lower cost. It's very useful for foreign investments. So it's a way to, you know, buying and selling futures contracts generally is less money out of pocket. Also, like I said, lower trading costs, and that usually can result in higher overall returns, especially if you tend to buy and sell those futures contracts in between the time of the futures contract was written and when the futures contract actually expires, because then there's no actual delivery and there's no you know, cost out of pocket for the actual whatever the stock that is within that index that you're supposed to purchase at the end of the futures contract. Classic market timing strategy, a switch between T-bills and stocks based on the market conditions. It's cheaper to buy T-bills than shift stock market exposure by buying and selling stock index futures. All right, index arbitrage. Exploiting the mispricing between, this is a strategy that exploits divergences between actual futures prices and their theoretical correct parity values to make a riskless profit. So this exploits the mispricing between underlying stocks and the future index contract. The futures price is too high, we short the futures by buying the underlying stocks. If futures price is too low, we buy long futures by selling the underlying stocks. Index arbitrage is difficult to do in practice. Transaction costs are often too large. Trades must be done simultaneously. Basically, it's a continuous motion thing, where if you're really wanting to make money on arbitrage, because arbitrage effectively, what it's saying, arbitrage in its the shortest form of what it is the difference between an actual value and what the market is valuing something at a given time. But generally, the market should correct itself in a short time frame. So this is, when you're dealing in arbitrage, you're talking about quick, you know, quick trades on a very regular basis. So it does take a lot of work, and usually, like I said, transaction costs can be high. Foreign currency exchanges. There's forward contracts. Currency markets are the largest in the world. They're available from large banks. Used extensively to hedge foreign currency transactions. So think about if you're an international company and you deal in multiple currencies, to hedge and make sure that you're not going to lose money on the exchange because the valuation of the currency changes. You can buy forward contracts to try and aid or at least lessen the potential blow of a big swing in the valuation of your currency. Futures contracts are available for major categories. March, June, September, and December delivery contracts are usually available. So here's different currencies. Here's in US dollars, the value compared to the US dollar. So you can see, you know, the US dollar is still pretty strong from, you know, compared to a lot of different dollars, but you do get over like the Bahrain dinar is worth more than $1. The UK pound is worth more than $1. Swiss franc, I believe the euro is too. Where's the euro at? I'm not seeing that. European Union euro on here. Okay, move on. Oh, there it is. Euro 1.12, also a little bit stronger than the dollar. Interest rate futures. Major contracts include Eurodollar, Treasury bills, Treasury notes, and Treasury bonds. Some foreign interest rate contracts are also available. The short position of these contracts will benefit if the interest rate increases. Long position benefits if the interest rates fall. So if you're counting on the interest rates to either rise or fall, then you want to take a short position if you think it's going to, if rates are going to increase, and the long position if you think rates are going to fall. Interest rate futures. Hedging the futures often requires a cross hedge. A hedging spot position with a futures contract that has a different underlying asset. So the example, a hedged corporate bond by selling treasury bond futures. So if you have a corporate bond and you're selling treasury bond futures, then you're protecting yourself against interest rate changes. Interest rate swap. So one pays the other a fixed rate of interest in exchange for a variable rate of interest. Usually the actual principal itself is not exchanged. And so company B pays a fixed rate of 7.05 to swap the dealer In return for LIBOR, company A pays 6.95 to the dealer. In return for LIBOR, and the swap dealer realizes the cash flow in each period. Excuse me, of 0.1% of the notional price. All right, currency swaps. Two parties agree to swap principal and interest payments at a fixed exchange rate. That firm may borrow money in whatever currency that has the lowest interest rate and swap the payments into the currency that is preferred. So if there's low interest rates on British pounds, you could borrow it in British pounds and pay it back in dollars if there's higher interest rates in American dollars, or vice versa, whichever way that goes. And that is it for chapter 17, and that is the last lecture for investments.